Hi, welcome to this discussion. So in this today tutorial, we are going to discuss about off-balance sheet financing. So what is off-balance sheet financing? The off-balance sheet financing, the name itself it is selling. Financing of an asset, again which is not affecting the balance sheet of the company. So the off-balance sheet financing occur when a company arrange financing or acquire asset in a way does not appear directly on its balance sheet. It allows companies to improve financial ratios such as debt equity and return on asset without increasing reported debt. So, on balance sheet financing is a method which raising fund or financing a asset without affecting the balance sheet of the company. Again, off balance sheet financing is right way, it's not illegal, but it's required proper disclosure and footnote in the financial statement. If a company using off balance sheet financing, it is 100% allowed as per the accounting standards, but it should be reflected or it should be disclosed in the footnote of the financial statement. So now we will discuss different types or method of off balance sheet financing. The first one is operating lease, special purpose entities, factoring of receivables, and joint ventures. So there are mainly the four common methods or types for off-balance sheet financing. First one, the operating lease. Next one, special purpose entities. The third option, factoring of receivables. The fourth option is joint venture. So again, why companies use off-balance sheet financing? So as we discussed, off-balance sheet financing is a financing of an asset, but it's not affecting the balance sheet of the company. That means it will help to improve the financial ratios, like keep debt of balance sheet, enhancing debt equity and leverage ratios. That means which enhancing debt equity ratio and leverage ratio, which will improve, which will show a good debt equity and leverage ratios. Again, risk transfer. In certain due to off balance sheet financing, the company can transfer certain risk to another entity. That means this company is not directly financing this asset. That means is there any obsolescence or is there any damage to asset? So this risk can be transferred to another entity. Flexibility in financing. The off-balance sheet financing provide access to funding without increasing reported liability. So this off-balance sheet financing is providing fund without increasing reported liabilities. That means it will increase, it will is an opportunity for financing without affecting the reported liabilities. Regulatory on convenient complaints. That means just assume that if a company have a certain debt regulations or limit of debt, so in this case the companies can use off balance sheet financing. That means this company can overcome this regulation and finance more asset by using the debt. So let's look into this case. This is for an off balance sheet financing. So just assume ABC Manufacturing want to acquire a new production facility worth 10 million. Instead of borrowing and increasing debt, ABC enter an operating lease for the facility. The lease payment appear as expense in income statement, not as the liability on the balance sheet. So this is the first method of balance sheet financing, that is operating lease. That means instead of buying that asset, we are leasing that asset. That means in this case, this debt and asset will not show on the balance sheet. Again, there will be an expense or monthly expense of lease payment which will show on the profit and loss account. So that means there is no debt or no asset is reporting in the balance sheet. Instead of that, it show appear a asset, appear an expense in the income statement, not as liability in the balance sheet. If we enter into a lease agreement, which is automatically showing a lease payment as an expense in the profit and loss account, but if it's not showing a liability on the balance sheet. So the effect of this operating lease, total assets and debt in the balance sheet remain unchanged. That means the operating lease, we are using that asset, but that asset and the liability is not affecting in the balance sheet. Return on asset appears higher because this asset is not showing in its asset list in the balance sheet, So obviously the return on asset is better, appearing higher. So now next we will move into different type of balance sheet financing. The first one is operating lease. Operating lease simply meaning an rental agreement where lessor retain ownership of the asset and the lessee use the asset for a period than its useful life. The leasee does not appear as an asset or liability on lessee's balance sheet. That means that this is simply a rental agreement, leasing an asset instead of buying the asset. So, in effect, the lease payment as expensed in the income statement. In this case, there is no asset, no liability will report in the balance sheet. But again, the lease payment show as an expense in the income statement. Lessee does not record depreciation or interest expense. The lessee mean who is using that asset is not recording the depreciation or interest expense related to that asset. This is very common for equipment, vehicle or building. This is very useful or very common for the asset like equipment, vehicle or building. That means this is no, instead of buying the asset, the business can lease the asset. So the leasing is definitely it will not show in the balance sheet as a debt or as an asset. Instead of this, it is reporting a lease payment, monthly lease payment in the profit and loss account. So just look into this example. XYZ Corp lease machinery for 5 years with the annual payment of 100,000. So in its balance sheet, the no liability or no machinery is recorded. But in the income statement, it is showing 100,000 as lease expense for each year. That means this is the lease agreement. So this lease payment is reported as an expense in the income statement each year. So the benefit, keep total asset and debt lower, improving leverage ratios. What is the benefit for this company during this? Is keeping its asset and debt lower and improving its leverage ratios. So what is impact on financial ratios? The debt equity ratio shows normal because this debt is not reported in the balance sheet. So the return on asset will show higher because the asset also not recorded in the balance sheet. So in the debt equity is showing will show as lower because this debt is not recorded. Again, the return on asset will also showing higher because this asset is not recorded in the balance sheet. So we will move into another type of off-balance sheet financing, that is special purpose entities. A special purpose entity is a separate legal entity created for a specific limited purpose such as financing or owning asset. Companies often use special purpose entity to isolate financial risks and achieve off-balance sheet treatment. So what is special purpose entity? Special purpose entities, just assume if a company want to finance a big project. So instead of financing it directly, this company is creating a special entity or a separate legal company or entity to finance this only for this project. So the special purpose entity has independent legal existence. That means it is registering, it is creating as a separate legal existence. And the parent company can transfer the asset and liability to special purpose entities. The special purpose entity can raise the fund or issuing bond or another debt fund without increasing parent's reported debt. That means what is the purpose of this? The purpose of this to show instead of financing a project directly, so this parent company creating a special purpose entity, separate legal existent entity to finance some project. So what is happening now? Now this parent company is transferring its asset and liability to the special purpose entity. So just assume if a company want to finance $50 million real estate project. So this company can create a special purpose entity only for this purpose. And this special purpose entity issue bond to fund construction And this liability of 50 million liability is on this special purpose entity's balance sheet, not on the parent company balance sheet. So this debt or this liability is showing only on the this special purpose company balance sheet, not on the parent company balance sheet. So what is the benefit of these special purpose entities? It's showing the parent company balance sheet show lower debt, and also the risk of project is legally transferring to the special purpose entity. Instead of doing directly by the parent company, this parent company created a separate legal entity and transferred this asset and debt to this special purpose entity. So what happened now? Now the parent company balance sheet showing better. That means it's not showing that much debt, and also the risk of the project also transferred to the special purpose entity. If the project failed, it is directly not affecting the parent company. So again, some things we have to consider here. The misuse of special purpose entity can lead to financial sanctions, because all the off-balance sheet financing, if we are doing off-balance sheet financing, it should be properly reported and disclosed in the financial statements. And it requires full disclosure in the financial statement. If a company doing special purpose entity for off-balance sheet financing, it should be properly reported in the financial statement as a disclosure. So this is special purpose entity. So what is mean? It is creating a separate entity to finance a special project. So what will happen here? The impact of in the financial statement is the parent company does not show this debt and asset in its balance sheet. So its balance sheet appear good. Again, this is transferring all the risk of the project and also of the debt and asset into this special purpose entity. So next we will move into another method of balance sheet financing, that is factoring of receivables. Factoring of receivables simply means it's selling of its receivable to a third party, that is a factor at a discount in exchange of immediate cash. That we just assume that if I have a receivables but it is not due for payment, so what I can do, I can sell this receivable to a third party. What we call this third party is factor at a discounted price. Just assume if I have a receivables of $100,000, maybe this guy will pay only $90,000 for me. So this 10,000 will be the profit or margin for this factor. Factoring occur when a company sell its account receivable to a third party, or we call a factor, at a discounted in exchange for immediate cash. This allows company to remove receivables from the balance sheet. This allows the company to remove this receivable from the balance sheet and improve the liquidity without increasing debt. Factor assume a risk of collection. So this will improve the liquidity without increasing the debt, and the factor is assuming for the factor there is a risk for collection for this factor. So it is normally using the companies with a long receivable cycle. If a company have a very long receivable cycles, so normally the factors will happen. That means this company can sell its receivable to a third party, that is called factor, at a discounted price. So let's look into this case. Just assume this company has 500,000 in account receivable. It sells this receivables to a factoring company at 480,000. So in the balance sheet, what will happen? The account receivable decreased by 500,000. The cash increased by 480,000. That means this account receivable decreased by 500,000. That means this receivable is transferred to factor. Again, cash increased by 480,000. That means for this receivable, the company is receiving immediate cash from the factor. So what will happen here? So this 20,000 as a difference of this account receivable and cash, this is an expense to the company. So this 20,000 will report as a loss due to discount. So the benefit of factoring is it to improve cash flow for working capital need. Just assume if a company have immediate cash requirement, but if it doesn't have cash in hand, so what this company can do factoring. That means he can sell his receivable for a discounted price. Keeps liability lower than traditional borrowing. So instead of this, so just assume the company have two options. One is factoring, one is borrowing, traditional borrowing. If the traditional borrowing, definitely it will increase the debt liability, but in the factoring, it will not increase the debt liability, and it will improve the liquidity without affecting the debt liability. So this is about the factoring. So what is factoring mean? It is selling its receivable at a discounted price. So next we will move into joint venture. So what is joint venture? Joint venture simply mean creating a special company where two or more company contribute to resource for a special project or sharing profit losses and control. Just assume there is a big project, the mass project is feasibility is there. So some companies, what we can do, they will join with the companies in the similar field or the field which requires a special expertise for this project. So they will join, two or more parties will join, or they will contribute resources for a specific project. They are sharing loss, profit, and control. So it's a special purpose entity. So what is the difference between the special purpose entity and joint venture is special purpose entities, there is a single company creating another entity for for a special purpose. Or in the joint venture, the multiple companies joining to create a separate company for a specific project. So all these companies will share profit, loss, and is controlled. So the JV can be structured as a separate legal entity. So joint venture will be a separate legal entity. Each parties report its investment in JV, not in the full asset and liability. So in the parent companies, each parent's company's balance sheet, it is reporting its investment only in the balance sheet, not the full asset and liabilities of the joint venture. It is commonly used for large infrastructure, energy, or international project. That means it will require huge resources. So in this case, the multiple company or two or more companies will join and they will create a special entity to finance and control this project. So let's look into this case. So there is a two companies are form a joint venture to build a power plant. So each company will invest 10 million, and this joint venture on the plan and borrow 30 million. So both the company report only this 10 million investment on its balance sheet, not the 30 million borrowing. So this joint venture received 10 million from both companies and is borrowing another 30 million to finance this project. So this both the parents company will show only 10 million as an investment on each parent company balance sheet. It is not showing the 30 million debt of the joint venture. So what is the benefit of this? It's reduce the reported debt for the parent company and which share the risk and cost of larger projects. Just assume if a company alone cannot finance such a big project, so they can form a joint venture. So it will share the risk and cost of this large project with another entity or with multiple entities. So just we are looking into why companies use off balance sheet financing. The first reason is improved financial ratios. That means while we are using off balance sheet financing, it is not showing this debt in the balance sheet. So it will show balance sheet as good, and it is enhancing debt equity, leverage, and return on asset ratios. That means if you are using off balance sheet financing, the debt and asset is not showing in the balance sheet. So it will improve debt equity, leverage, and return on asset ratios. So next, transfer of risk. That means transfer of operation or financial risk to another entity. So instead of financing, just assume a special purpose entity case. Instead of financing a company itself, it is creating a separate entity to transfer this risk. So it is transferring operational and financial risk to another entity. Instead of bearing all this entity by parent company, the off-balance sheet financing transfer the financial and operational risk to another entity. So another reason is enhanced liquidity. So just as in the case of receivable factoring or factoring of receivable. So in this case, what company can do is can raise fund or cash without increasing the reported debt compliance. That means just assume a parent company have a limit to borrow or there is a limit for its debt. So in this case, this company can do is can create a joint venture or a special purpose entity. So this special purpose entity or this joint venture does not affect this limit because it is a separate legal entity. Again, large project financing. Just assume there is a massive big project. Just assume there is a massive big project. So this massive project cannot be financed by a single entity. So in this case, what company can do, they can create joint venture to finance this big projects. That means the two or three or multiples company can join together to create a joint venture, and together they can finance this big project. So in this way, the cost and the risk also sharing with these multiple companies. Just one example how this off balance sheet financing affecting the financial statement like balance sheet and income statement. So in the operating lease, it is not affecting the balance sheet. That means it is not showing any additional asset or liability in the balance sheet. So in the income statement, it is reporting lease expense. So in the so the for the operating reason, it is not affecting the directly not affecting the balance sheet, but in the income statement, it is reporting as lease as an expense. So in the special purpose entity, so the liabilities of special purpose entity is reporting only the special purpose entity books, not in the parent company. So in the income statement, there will be some interest or lease may appear in the parent depending on its structure. So in the income statement, there should be some interest or lease payment is with effect due to the special purpose entity. So in the due to let's come to factoring. In the factoring, in the balance sheet, the receivable definitely will decrease because it is selling its receivable for a discounted price. So also in the income statement, there is a loss or a discount is recording as an expense or loss in the income statement. So in the joint venture, so the joint venture in the balance sheet, it is in the parent company balance sheet, it is showing only as equity investment. But in the income statement, there will be the share of profit and loss will be recorded as a other income or any other heads. So in the joint venture, the parent company investment only showing in the balance sheet as a equity investment, not complete debt and liabilities of the joint venture. In the income statement, there will be some share of profit or loss will be recorded from the joint venture. So what we discussed today is off balance sheet financing. Off balance sheet financing is simply the financing of an asset or a project without not directly affecting in the balance sheet. The off balance sheet financing of asset or acquisition that does not directly on the company's balance sheet, used to manage the financial presentations. The common method for off balance sheet financing are operating lease, special purpose entity, factoring of receivables, and joint venture. This is a commonly used method for off balance sheet financing. So the purpose of off balance sheet financing improve financial ratios, enhance liquidity, transfer risk, and help comply with the debt covenants. So the impact of financial statement, asset and liability often remain lower, improving return on asset and leverage ratios. So due to the off-balance sheet financing, the asset and liabilities normally showing as lower because this off-balance sheet financing is not recording on the balance sheet. Again, it will improve the return on asset and leverage ratios. That means the assets also not showing in the balance sheet, so it will improve the return on asset and also improve the leverage ratios. So in the income statement, it is showing some expenses like lease payment, factoring discount. It is affecting the net income. Again, the important thing is must ensure transparency and disclosure when we are using off balance sheet financing. That means it is 100% okay to use off balance sheet financing for a company, but it is very important to disclose the off balance sheet financing if a company is using off balance sheet financing. Otherwise, which will may lead regulatory complications. So what we discussed today is off balance sheet financing. If you have any doubt, you need extra clarification in these topics, please comment on the comment section. Again, I'm giving the downloadable link of this PDF file for your reference. You can download and use this PDF file. Thank you for watching this video.